Hello and good morning to everyone from the German-Irish Chamber of Industry and Commerce. Thank you all for participating in our webinar today. The topic is Europe's recovery after the pandemic. We have two excellent speakers from the German and Irish Central Bank. We have the German ambassador and two board members of the chamber as well. You will get to know them soon. One is our moderator, who you will see now on the screen as well in a second or two. Good morning, Declan. Good to see you.
Good morning, Ralph. How are you?
Good, thank you. Good. Declan Bolger will guide you through the next hour. Declan is board member of the chamber and member of our Financial Service Committee. And more important, I have to say, in his real job, he is CEO of the Irish Life Insurance Group. He's based here in Dublin. Before I hand you over to Declan, three final remarks. All presentations, all speeches are on our website from tomorrow onwards. Keep in touch with the chamber. We have interesting webinars lined up. Enjoy the morning with us. Without further ado, Declan, thank you for your time and please take over. Thank you.
Thank you, Ralph. My first job today is a very nice one. It's to introduce Her Excellency, Mrs. Dajke Potzel, the German Ambassador of Ireland, to formally welcome us today. Dajke has been Ambassador since December 2017, and during that time she's been a great friend to the German-Irish Chamber, and also a great supporter of Irish business, Irish culture, and many worthy causes, as she's visited the four corners of Ireland in her time here since 2017. Good morning, Ambassador. Top Ultra Road.
A very good morning to you, dear Rief.
Die wit? Die smurwit. Mahu.
Right. Thank you so much for the warm words, Declan. Can you see me? I don't know. Can everybody see me?
Not yet, I don't think.
All right. Now?
Yes, we can now, yes.
Yeah. Lovely, lovely. Excellent. So thank you so very much for having me. I think this is another excellent example of our close cooperation between the Chamber and the Embassy. So I'm very happy to be here. And I'm also very happy to see a few people there whom I haven't seen for months now in person. So it's great to at least see you here, like for instance also Mark Cassidy from the Central Bank. I think the last time we saw each other in the residence was one of the last events that I had before lockdown. So it's great to see you at least on the screen. I just wanted to say a few words also on the EU presidencies program. As you know, we've taken over the EU presidency on the 1st of July, and that fits in very well with the topic of this seminar, of this webinar, because to overcome the COVID-19 pandemic crisis, to get Europe back on its feet economically, but also socially, is like the main priority of our presidency. So we really feel that what we need to do is find a way to contain the virus, so go on with crisis management within the European Union in a coordinated way, in a way of solidarity with each other. We also, apart from containing the virus, we need to find ways to use that crisis to get out of it stronger than we used to be, and that means putting a lot of effort into economic recovery in the coming months. So one really important measure there is, of course, the MFF, the Multi-Annual Financial Framework, but also the Recovery Fund that's been talked about so much in recent weeks. We really hope, and the Chancellor was very clear about it again yesterday when she spoke in the European Parliament, we hope that we get an agreement as soon as possible. Of course, we would love to have that agreement next week in the European Council on the 17th and 18th of July. But obviously, I mean, we are still pretty much apart within the EU member states, but we really hope that consensus can be built. And the Chancellor also said extraordinary situations demand extraordinary answers, and this is really a unique situation that we are in. Some people, and our Chancellor too, had sort of compared it with post-war, post-Second World War scenarios in Europe. It is a dramatic situation, it's a unique situation. So what we hope for, and what we also as Germany want to show, is a unique and extraordinary act of solidarity between the EU member states, because we feel that that is absolutely necessary. We also need to get better in crisis management. That is also something that we would like to focus on during our presidency. Now, I'm not going to go into the full program here. Whoever is interested can read up the 26 pages on our website there. But I just wanted to highlight a few points, and that is, like, as I said, the primary focus will be to overcome the COVID-19 pandemic. But that also means to really create not only a budget for the future, but also to look into issues like the Green Deal and digitization, which are very important to us. So we feel that we can use this, this crisis also as a chance for investment in sustainability, the so-called green recovery. And with its European Green Deal, we feel that the EU Commission has already put a very ambitious agenda on and proposal out there to be implemented, and we really also want an equally ambitious follow-up in the Council. And that includes to finalize the European climate law and a Council position on the new EU nationally determined contributions under the Paris Agreement, so that we can really reduce our CO2 emissions. We feel that we also need European digital and technological sovereignty more than we do have it at the moment. We feel that this was clearly shown also by this pandemic, that we need to be more sovereign, that we need to be more independent of others, and that we need also to build up an efficient and trustworthy European data infrastructure. We will also support a resilient, value-based digital transformation in the coming months. Now, having said that, the EU presidency's role is limited, but we hope that we can push the agendas as much as possible. Our foreign minister said we want to be a driving force, but also a facilitator. We want to build bridges between member states to really achieve the best possible outcome in this dramatic situation. And let me just say a couple of words to sum up on strengthening European social cohesion, because that is also in the context of the economic recovery is very important to us. It's one of 9 priorities that we have set ourselves. So we want to really make progress on the implementation of the European Pillar of Social Rights, and that for us means with the EU framework for a national minimum wage or minimum security schemes. So that's very important to us, as is the development of an unemployment insurance scheme on the basis of an EU Commission proposal. And we are also very committed to strengthening the youth guarantee and to tackle youth unemployment. So what is really dear to our hearts, of course, is also, and I mentioned that here because it is of particular importance also to Ireland, of course, is the urgency to conclude negotiations with the United Kingdom on the future relationship. We feel really that urgency is growing tremendously. We know we only have a couple of months left to come to an agreement. We still hope for an ambitious agreement with Britain, but on the other hand, we see very clearly that time's running up, and we need to be prepared for all possible outcomes. So also a no deal is a possibility, and we need to prepare ourselves. So we need to sit together, and they are doing that in Brussels, to get ready, to be prepared also for that outcome. But of course, we will still support Michel Barnier as our chief negotiator with the British to get the best possible outcome. We also want a very close relationship with the British And we still hope that that's going to happen, because it will also obviously have tremendous economic implications for us if we don't get an agreement. And so we need to be, and we will push that agenda, of course. So those were just a few of the 9 priorities, but I just wanted to focus on these in the framework of this webinar on the economic recovery. So quite a lot on our plate. We need to work together, and we're very grateful to Ireland that they are so closely supporting our agenda. And I am personally looking forward to working with our Irish friends here in Dublin, but then obviously also in the European context. We are very much looking forward to working with Ireland on these really important issues. And I haven't mentioned rule of law, I haven't mentioned the role of Europe on the global stage, but those are all issues that we need to work on together. And so do keep your fingers crossed and support us wherever you can. So thank you very much for having me, and best of luck with the seminar today. Thank you so much.
Great, thank you very much, Ambassador. Okay, I think today's session is very well timed. I think in the early months of the COVID crisis, many business leaders were very much focused on their own businesses, initially to make sure that their customers and the staff were safe, and then looking to adapt their businesses so that they can remain operational during this time, and then ensuring that their distribution and their sales channels can be as effective as possible in the changed circumstances. I think as people got through those steps, the focus then moved more broadly to look at what the overall economic effect was to Ireland, to Germany, to Europe and the world, to look to see how economies could recover from this situation, and then to see what business leaders themselves and also governments could do to accelerate that recovery. So I'm delighted today that we're joined by 2 real experts in this field, by Dr. Jens Ulbrich and by Dr. Mark Cassidy, who have at least 2 things in common. One which I think you're aware of is that they're both the chief economists of the respective central banks, the Bundesbank and the Central Bank of Ireland. But what I learned myself in the last 10 minutes, both are also former students of Trinity College here in Dublin. So what we will do is that we will have 2 presentations, each of 15 minutes. Jens will go first, followed by Mark. And then also we're allowing time of about 15 minutes for questions and answers to both Mark and Jens as well. So we're very excited and honored to have 2 such distinguished speakers here today. So please do use the opportunity to ask your questions. You should see in the webinar functionality a spot on the right-hand side of your screens, I think for most, where you can ask questions. So please do submit questions. What we'll do is we'll gather these over the course of the 2 presentations, and then I'll have the opportunity to put those questions to both Jens and Mark at the end of the 2 presentations. So I think without further ado, I think I'll pass over to Jens. So whenever you're ready, Jens, if you'd like us to bring us through your presentation.
Well, thanks a lot, Declan, for the very nice introduction. Yes, it is now 25 years ago that I lived in Dublin and studied at Trinity, and I would have loved to come back and see that wonderful city again. But due to the COVID-19 developments, I think we have to do it in a virtual way. So what I would like to do in the following 15 minutes is to give you some perspectives on the German economy, try to introduce some of the challenges forecasters were confronted with, given the unprecedented scale of that shock and the speed with which global economies were sliding into recession. Then I want to give you some latest picture of latest indicators signaling where we are on the recovery path. I will illustrate a little bit the German fiscal policy response. And if time allows, I will also say something on the European presidency, but the ambassador, I think, has covered that already in a very comprehensive way. So if we would go to the next chart, I think the speed with which European economies have slid into recession is quite unprecedented. And this kind of COVID-19 shock for us was also completely new, given that political measures locked down more or less the whole economy. And what you can see here is from Oxford University, an index that is trying to portray the strictness of lockdown measures for the euro area and for the 4 largest euro area countries in the bottom part of the panel. What you can see is that from the end of February on, especially in Italy, the lockdown measures were implemented at a rapid scale. You can see that the other 3 large euro area countries were following with, I think, 2 to 3 weeks lag. And what you can also see is that there is a certain heterogeneity among the strictness of lockdown measures. In Germany, for example, the lockdown measures were not as strict as in Italy, France, or Spain. And I think this is partly due to the fact that we had a 2-week window of opportunity after developments in Italy and the Lombardy became visible. And we used that time to increase hospital capacities, especially intensive care capacities. And we were never in a situation where the hospital system, the health system, was overstretched, not in a way it has been in the other 3 euro area countries. But that was to a great part also sheer luck that we had 2 weeks time to get prepared. If you look at the next chart, you can see that this COVID-19 shock for us at the Bundesbank, and I assume also for Mark, meant really important new challenges. Usually when you do forecasting, you rely on your established relationships, on your established indicators, you trust the dynamic relationships in the economy. Confronted with the COVID-19 shock, the situation was completely new, and we were not sure whether we could really trust on our old traditional short-term forecasting models. And it is also true that economic indicators, even when you try to nowcast the state of the economy, the current state of the economy, these indicators come with a certain lag. But as I have said, the speed with which the German economy was sliding into recession was unprecedented, and we thought that our traditional indicators are of no help or of little help in analyzing the actual situation of the German economy. So what we did is we looked at more timely indicators, higher frequency indicators, and here you can see, for example, the number of manufactured passenger cars in Germany with a deep slump in the first quarter of 2020. But you can also see higher frequency data like truck toll mileage indices and realized electricity consumption. And what we did is then we used all these new data and high frequency data to construct an economic activity index for the German economy on a weekly basis. This is parallel and quite similar to what the New York Fed has done for the US. And on the right-hand chart, you can see the weekly activity index for the German economy. I will not go into the technical details of that index. You can read it on our webpage, and it is updated every week. But basically, we use these kind of high-frequency indicators, bundle them together, try to extract a common component on a weekly basis, and as this is done on a 12-week rolling average, it indicates the level of the index indicates the GDP growth rate for the past 12 months. So at the end of each quarter, the level of the index, the blue line, would indicate GDP growth on a quarterly basis for the past quarter. And if you look at the index level at the end of March, for example, it would have signaled a quarterly GDP loss of -2%, slightly below -2%, and the black bar shows you the actual published figure of the statistical office in Germany, and you see the index has done quite a good job. if we go and look at the second quarter, you see that the steep decline due to the lockdown measures might have brought the German economy to a quarterly loss in the second quarter of 7% of GDP. Actually, our estimate would be a little bit more pessimistic and higher than -7. And then you can see with the lifting of some of the lockdown measures, economic activity recovered a bit, and the German economy seems to walk out of the deep hole it has been in the second quarter. So I think the worst lies behind us with regard to economic activity, but the recovery will arguably be a gradual process, and it will not imply that we come back to pre-corona levels of economic activity anytime soon. On the next chart, you can see the developments for major components and sectors on the supply side of the German economy. As I said, German GDP loss in the first quarter was minus 2.2% on a quarterly base. This is much less than what we observed for the euro area. So the German economy did not suffer that much as other euro area economies. But you clearly see that this kind of recession is untypical in a particular sense. Usually in recessions, or in German recessions, you see that manufacturing, the industrial sector declines, but that the service sector at least is more resilient. And what you can see here now for the first quarter is that also services declined massively, but you see the decline in manufacturing was extraordinary, and it hit the German economy in a phase where the industrial sector has already been weak since a couple of quarters, or to say since the beginning of 2018. What explains the more resilient GDP response in Germany is that we have one sector of the economy that is still or has still been quite dynamic in the first quarter, and that is construction activity. Might also partly be due to the mild weather in Germany in the first quarter, but that clearly explains why the economy has been more resilient in the first quarter. But we expect that construction activity will also be dampened in the quarters ahead. The next chart, please. Would it be possible to switch to the next chart? What you can see here is some tentative signs of recovery, but what you can also see is the unparalleled decline of a lot of economic indicators we usually observe. What you can see here is consumer climate in Germany, and you see that the overall consumer climate collapsed in the first quarter. You see that income expectations, that is the green line, were in free fall, and that the propensity to buy durable goods was also in free fall. And you see that there is some recovery in these figures, but by no means we have reached the pre-corona levels. When it comes to consumers' income expectations, what we have also tried to do during the COVID shock, we have used our household survey at the Bundesbank to augment it with ad hoc questions regarding the impact of the COVID shock. And quite interestingly, if we ask German households, the majority still expects no income loss, but over nearly 50% expect income losses in the next 12 months ahead. On average, the monthly expected income loss is 100 euro. That is not that much, I would say. But more worrying for us is that 1/3 of all households expect income losses with 100% certainty, and these income losses would then be 600 euro or more than 600 euro on a monthly base. And what is also problematic is that these income losses and the expectation of income losses is centered at low-income households. And what is also remarkable is that women expect higher income losses than men. So there are tentative signs of recovery on the consumption side, but I think we are well advised to expect that private consumption will not return to pre-crisis levels very, very rapidly. On the next chart, you can see you can see what this meant for the baseline of our forecast of the German economy. And you see here on the right-hand side the GDP growth rates. We expect a GDP decline of roughly 7% this year, and then a recovery with slightly above 3% growth next year and approximately 4% at the end of the forecast horizon in 2022. This is a GDP decline that is much larger than the decline in the productive capacity, that is production potential of the German economy. The difference between both actual GDP and production potential is a measure called the output gap that indicates to what degree aggregate economic capacities are over or underutilized. And what you see on the bottom part of the left chart is that the output gap in Germany will turn negative or has turned negative with unprecedented speed. And in 2020, we expect a negative output gap of over 6% of GDP. And then with the economic recovery and GDP growth rates I just described, we expect that the output gap narrows somewhat, but even at the end of 2022, the output gap will still be negative and the German economy will suffer from underutilized capacities. And on the right-hand side, you can see a couple of major macroeconomic aggregates for the baseline forecast. You see, for example, that the labor market remains quite resilient. We expect the unemployment rate to increase this year to 6.1% compared to 5% last year, and to move up next year to 6.7%. But compared to other countries, or if you look at US figures, this is still, regarding the unemployment rate, quite a surprising resilience. It has to do with the fact that a lot, and I will come to that later, a lot of the negative labor market effect does not result in unemployment and people getting fired, but it is cushioned by a massive usage of short-time work schemes that is labor subsidized by the government to cushion and to come through the crisis. What you also see is that German exports decline massively. They will decline by over 13% this year, and imports will not decline that much. That also means that one of the hotly discussed topics of the German economy, the current account surplus, that has been 7.5% last year, will shrink to below 5%. And this is within 1 year quite a massive reduction in the current account surplus. And it will not return to levels over 6%, which are the critical threshold of the macroeconomic imbalance procedure at the European level. On the next chart, you can see that at this forecast round, we have changed a little bit our procedures, given the enormous uncertainty we faced. And I guess Mark will allude to that too, because it has been a common approach among Euro area central banks. We thought that it would be advantageous to think more in scenarios than just in a baseline. And we have developed 3 scenarios depending on the duration of the lockdown phase and, more importantly, depending on the speed of economic recovery. That has to do with some assumptions about medical progresses, about the possibility or likelihood of second waves. And you see that in a more optimistic scenario, the GDP decline would be 3.5% this year, and in a severe scenario, it would be 10%. The baseline is 7%. Given all the indicators we have seen since we finished the June forecast that I portray here, our assessment is we still stick to the baseline, and we are a little bit more optimistic than the baseline. So we are somewhere in between the baseline scenario and the less severe scenario. If we turn to the next chart, then you see how the German labor market will cope with the COVID shock. And what you see is that the decline of GDP in 2020 in our forecast of 7%, it can be divided by definition into a decline in total hours worked and a decline in productivity per hour. And on the upper part, in the upper part of the left chart, you see that the overwhelming burden of the adjustment of the GDP is in total hours worked. Productivity decline, productivity per hour declines much less. And if you decompose the decline in total hours worked, this is done in the lower part of the left chart, you see that it is a little bit a decline in total employment. That is what would show up in the unemployment rate. But the bulk of the decline is due to average hours worked. And I've already referred to it. If you look at the right chart, you see where that comes from. And this is the announcement of business cycle related short-term work. In Germany, it's called Kurzarbeit. And what you see is that in 2020, we now have over 12 million employees who are entitled to short-term work. Compare that to the great financial and economic crisis 2008-2009, and you see the massive scale of the current COVID shock on the German economy and on the labor market. To be precise, these 12 million are entitlements to short-time work. So companies have to report that they intend to use it. It does not mean that really 12 million German employees are under short-time work. But I think in the second quarter, a fair bet would be to assume that more than 6 million German employees have used these Kurzarbeit schemes. And that is, I think, a favorable scheme when the economic shock is not long-lasting and when the economic damage is not one where you would have to reallocate labor between different sectors. I think at the current juncture, short-time work is an appropriate response. But the longer the recovery process lasts, I think the clearer it will become for us which sectors will suffer from longer lasting damages and longer lasting declines, maybe due to shift in consumer preferences. And then, of course, short-time work is not the superior instrument. Then we have to find ways to enhance and accelerate necessary sectoral reallocation. But to be honest, at the current juncture, we have no clear knowledge, no good guess what will be the long-lasting impact of the COVID shock. And as long as this uncertainty prevails, we can afford a wait-and-see attitude. And the next chart illustrates why in Germany, at least, we can afford comfortable wait-and-see. That shows you the fiscal response of the German government, the federal level and the Länder level. What we have done here, or what I show here, is the figures we've put into our forecast. So this is what we really think will be the fiscal stabilization impulse. If you look at the press and let's say political communication, you see, of course, sometimes more confusing numbers, but these include also double counting, and these include grants between the federal and the Länder level. I think what really counts as a fiscal stabilization measure is what you think will arrive in the deficit. And for 2020, we expect that the stimulus, the discretionary stimulus, will be 5% of GDP. This is just the discretionary stimulus. This does not include automatic stabilizers. We think that automatic stabilizers like unemployment benefits, like the short-time work scheme I referred to, like Texas Social Security contribution, make up another 3.5% this year. So this means over 8% of deficit related to the COVID shock, over 8% in relation to GDP. Sometimes in international comparisons, you find for Germany massive numbers of fiscal support, ranging up to 40% of GDP. And this is due to the fact that these comparisons then include credit guarantees. And in Germany, the federal government has entitled the KfW, that is the Federal Development Bank, to hand out credit guarantees to commercial banks in a magnitude of nearly 1.3 trillion euros, and that is roughly 40% of GDP. But it is important to keep in mind not to be overly impressed with these numbers. These are just entitlements. This is not actual take-up of credit guarantees. So what we have done in our forecast, we expect that these credit guarantees will be only taken up by roughly 5% of GDP. And these are then not deficit relevant, but they are debt relevant. So they will show up in an increase of public debt in Germany. I think the massive fiscal response we see in Germany was possible because we had fiscal buffers built up in the run-up to the COVID shock. I remember that the government was heavily criticized for building up fiscal surpluses, but I think now the crisis shows that it is quite an appropriate fiscal strategy in economic good times to build up some fiscal buffers that would give you the fiscal space that you can use when a severe shock really hits. And this is, I think, one of the lessons from a fiscal policy point of view I would draw from that crisis. And if it turns out that the recovery is much more gradual, I think there is still fiscal space for additional stimulus packages. And the fiscal consolidation needs that will arise, they will also depend on the long-lasting impact of the COVID shock. So at the current juncture, and this is unusual for the Bundesbank, not to recommend immediate fiscal consolidation, we are a little bit silent on that issue because we think the uncertainty about really structural consolidation needs is so high that also here we would prefer to have a wait-and-see approach and then decide later where we see structural consolidation needs. I think I've a little bit overstretched my time, but I hope it was a little bit of interest to you, and I'm looking forward to your questions after Mark has then presented the perspective on the Irish economy. Thanks for your attention.
Great, thanks a million, Jens. That was excellent. I'll move on, and I think our next speaker is Dr. Mark Cassidy from the Central Bank, who's the Chief Economist at the Central Bank and is also the chair of the CBI's Brexit task force at the moment. So plenty on Mark's agenda. So Mark, as soon as you're ready, we're ready for you to take us through your presentation.
Good morning. Can you hear me now, Declan?
Yeah, that's perfect, Mark.
Great.
How are you?
Very well, thanks. Very well. Thank you very much for the introduction. And good morning, everybody. I'm very glad to have the opportunity to speak with you today. Let me thank the German Irish Chamber of Industry and Commerce for inviting me here. It's particularly great to have the opportunity to hear from Jens, who I've known for a good number of years, and what was a really interesting presentation. So maybe moving to the next slide, or the first slide, the focus of my remarks today is on the Irish economy. I will be very happy to discuss any broader issues afterwards. So let me first discuss the impact of COVID-19 on the Irish economy to date. I'll then look at some estimates regarding the potential impact on growth and public debt for the coming years under different scenarios, as with Jens's. And in my closing remarks, I will very briefly highlight some of the key issues that might affect the pace of recovery and some of the key questions for economic policy. So if we could go to the next slide, please, Ellen. And as Jens has highlighted, the severity and the sharpness of the impact of this pandemic has been without precedent. Our estimate is that overall domestic demand here fell by 20% in the second quarter. In terms of the labour market, and at peak at early May, there were almost 1.25 million people in receipt of one form of government support or other, which is almost half of the labour market, which is quite remarkable, I think. The standard live register, which excludes those who lost their jobs because of the pandemic, it's increased by around 20%, so from around 180,000 pre-crisis to 220,000 at present. The number of people who have lost their jobs because of the crisis and are on the special new pandemic unemployment payment, this peaked at around 600,000 people in early May. Since then, there has been a steady decline as the economy has been reopening, and this number fell to 412,000 last week, and it is announced that another 45,000 will receive their final payment this week. And there are currently around 400,000 workers supported by the government's temporary wage subsidy scheme. And as you see on the chart on the left-hand side, the unemployment rate, when adjusted to include the pandemic unemployment, it rose from around 5% pre-crisis to 28% in April and has subsequently declined to 22.5% in June. So if we could go maybe to the next slide, please. So what the next slide will show is the number of claimants of the pandemic unemployment payment by sector, and also how this has changed over recent weeks. It shows that by a long way, the largest number of jobs was lost in accommodation and food services, almost 120,000, followed by retail, trade, and the construction sectors. I won't go into the detail now, but if you get the opportunity to look at this graph later, you will see that as the economy has opened up in phases, over half of the jobs in construction have now been regained, but the recovery in accommodation and food services has understandably been much slower, less than 15% regained. This will, of course, pick up as bars and restaurants begin to open up. On the next slide then, please, and we look at some of the consumption trends. So you can see here, overall retail sales fell first of all by 12% in March and then by a further 36% in April. So it was a cumulative decline of around 45%. In part, this reflected precautionary savings, but also to a large extent what we call forced savings. In other words, people just did not have the opportunities or the outlets to spend their money. Since late April, early May, we have seen signs of recovery. Retail sales subsequently increased by 30% in May, but the figure was still down around 30%. The figure was still down around 30% in seasonally adjusted terms on the pre-COVID level. If you could actually go back one slide, Alan, I think. Yeah, perfect. So May, of course, was a long time ago. This chart shows trends in payments up to just last week. It shows, first of all, credit and debit card payments combined, which is the top purple line there. It shows ATM withdrawals, which is a proxy, albeit quite an imperfect one, for cash payments. That is the lowest blue line. And it shows all card transactions, namely the combination, which is the middle green line. And what the chart shows is, again, all transactions fell very sharply from mid-March when containment measures were first introduced. ATM withdrawals, you can see they fell by much more than card payments, 60% as against around 30% in annual terms. And the peak overall or aggregate decline was around 40%. Spending then, you see, it started to pick up from around mid-April. Card payments increased at a much faster rate than cash as people remained wary of cash. And the latest data at the end of the chart show credit and debit card payments now are actually up around 15% year on year, possibly boosted by pent-up demand for some services, as well as more preference towards card payments. ATM withdrawals are still down around 30%. And the overall transactions in value terms, it's back to around where they were a year ago, and it's only slightly below the level of 4 months ago when the virus emerged. But of course, there are very wide divergences across types of spending, and spending on services like travel, recreation, leisure services, bars and restaurants still very well below pre-COVID levels, while spending on food and groceries are very well up. So maybe turning to the next slide, please. So as people have been saving rather than spending, the value of deposits, household deposits in the financial system has increased at record levels. So in April, the value of deposits increased by €3 billion, which was the largest monthly increase ever. In May, there was a further increase, around €1.5 billion, which is still extremely high by historical standards. So as a result of this, the savings rate will increase markedly this year, and that's a result of the decline in consumption, also the income support measures. And what people do with these savings, whether they spend them, whether they use them to pay down debt, whether they maintain them as savings, will be extremely important in terms of the future path for the economy. So I might skip, for time reasons, I might skip the next slide and go straight to, maybe go to the one after, please. So that slide I'm skipping is just some of the findings from our market intelligence. You might want to look at that in your own time when the slides go up on the website. But maybe just to finish this part of the presentation, let me summarize some of what we've seen so far. So there has been an ongoing pickup in employment as the economy starts to reopen. Many businesses, though, will not open again, and many of those that do will do so with fewer staff. Businesses and sectors with a high degree of face-to-face contact will be most affected. Some types of workers are disproportionately affected depending on what sectors they work in, and these include younger, lower paid, non-Irish and part-time workers. And there are regional effects also, which could serve to widen existing income gaps between urban and rural areas. Spending, we have seen, it has clearly begun to recover, but for many sectors, it will take some time to return to previous levels, if at all. We will see an acceleration of some structural changes, for example, with regard to payments, including further move away from cash to electronic payments, as well as more online payments. And one issue I've not really had the time to discuss, but the divergent performance between indigenous and multinational firms, and in particular, pharmaceutical and medical exports, which account for over half of our merchandise exports, and IT services, which account for over half of our services exports. These both continue to perform very strongly despite the pandemic. So let me shift the focus here. Maybe if you could move to the next slide, let me move from the present to the future. And there is, of course, very significant uncertainty surrounding the outlook, as Jens highlighted, which depends on a number of factors, not least the path of the virus. So in a quarterly bulletin that we published last week, we have produced two alternative scenarios, very much in line with the central and severe scenarios outlined by Jens, though we did not publish the less severe scenario. So in our baseline scenario, then the strict lockdowns that were in place are assumed to be gradually unwound, essentially in line with the existing schedule for opening up the economy that has been announced by the government. Some containment measures will remain in place. Activity will remain constrained by both the economic effects of lockdown, but also the ongoing impact of the pandemic, including physical distancing. In the severe scenario, then, it is assumed that there is some resurgence of the virus at some point, and some containment measures need to be reinstated, even if not necessarily as stringent as before. It is assumed, though, that a vaccine can be produced or the virus otherwise brought under control sometime before end 2021. So this is not a worst case scenario. And in this scenario, there is also a greater permanent loss of output and larger scarring effects. So in terms of the estimates, and on the next slide, please. So I think this shows it best when we look at the levels of output and the rate of unemployment. So on the left-hand side here, we set the pre-COVID, the 2019 level of output equal to 100. The dotted line then is our pre-COVID forecast for output from our January bulletin. So this allows us to compare the levels of output under both the baseline and the severe scenarios with both the pre-COVID levels and where we might have expected to have been in the absence of COVID and positive growth had been maintained. So you can see in the baseline scenario, GDP falls by around 9% this year before gradually recovering, and it returns to the pre-COVID level in 2022. But that is still well below, almost 15% below where it might have been in the absence of the virus. For the severe scenario, the lower line there, the level of output falls by over 13% this year. And by 2022, it is still around 5% below pre-COVID levels and almost 20% below where it would have been in the absence of the virus. And in this scenario, it is 2024 before we return to pre-COVID levels of output. In terms of employment, as you can see on the right-hand side, under the baseline scenario, the unemployment rate averages 14.5% this year, but the inter-year developments are important, and following an average rate of 25% in the second quarter, you see the unemployment rate falling to around 15% in the third quarter and around 12.5% in the final quarter. And at the end of the horizon, the unemployment rate is around 7.25%. So maybe moving on to the next slide and turning to Brexit. So our baseline and our severe scenarios that I mentioned, they both assume that some form of limited free trade deal can be agreed. Of course, there's very considerable uncertainty, and if no deal can be agreed and trade moves to WTO arrangements, this would imply an even larger divergence from existing trade arrangements with further negative effects for the Irish economy. So already COVID-19 has had an impact on the outlook in relation to Brexit. It has impeded the negotiations, with both sides meeting less frequently. It has impeded the preparations of firms, particularly SMEs, and also public authorities for the new trading arrangements. And critically, it leaves businesses and the public finances in a much weaker financial position to deal with the Brexit shock. So for the agri-food and tourism sectors, the COVID crisis is likely to amplify the effects of Brexit, while for others it may stunt the recovery. And on the next slide shows then our estimates of the outlook if no free trade deal is negotiated and trade transitions to WTO terms. We use a macroeconomic model for this. We actually look at two Brexit scenarios, one where there is a relatively orderly transition to WTO arrangements, the other a more disruptive WTO outcome that manifests itself in greater uncertainty for business. And I emphasize the uncertainty around these numbers, but overall, compared to a free trade agreement, we think growth next year will be around 0.7 to 2 percentage points lower compared to a free trade agreement. And over the longer term, and the model is more reliable over the longer term, the effect could be around 1.5 percentage points. So let me turn, and I'm conscious of time, let me turn to the estimated impact on the public finances, and on the next slide then. So we think that the direct cost of the crisis this year, we think, will be around 9 billion, or around 5% of GNI star, which does not include the credit guarantees nor the effects of the automatic stabilizers. So in the baseline scenario, following a modest surplus last year, we expect the general government deficit to be around 23 billion euro this year, or 12.7% of GNI star, before improving to 6.5% next year and 5.7% in 2022. And then maybe turning to the next slide in terms of the debt level. So in the baseline, the gross debt increases to around 120% of GNI star before gradually improving in the following years, while in the severe scenario, the level increases to around 130% this year and further to 132.5% next year before starting a more gradual downward trend. So let me conclude with the final slide, and what we see as some of the key issues. I won't go into these, but happy to discuss afterwards. So in terms of households, key issues relate to developments in incomes, consumption, and savings. For firms, in addition to the loss of demand, supply constraints such as physical distancing may bind. The longer the issues last, the more likely that liquidity problems could translate into solvency problems. And the pace of recovery will depend critically on the extent of retrenchment through firm closures, lower investment, and layoffs of staff. And of course, there are key issues also in relation to the public finances, including how high debt and refinancing costs will rise, what scope might exist for further stimulus measures, and we think there is still further fiscal space, and when will the government need to think about lowering the debt ratio. But let me maybe leave it there and hand back to Declan, and happy to take any questions on any of these issues.
Great, thanks a million, Mark. That was really, really good. I think I'll move straight to questions. We're a little short on time, and to be honest, I think Jens and Mark's presentation was so comprehensive. They've already answered some of the questions seen coming through. Maybe one for both of you, that we focus very much on the Irish and German economies, but I think both countries are very much export focused as well. So do you have any comments, reviews just on the prognosis for the global economy, and what are kind of the key factors we should be looking out for? So maybe put that one to Mark first of all.
Okay. Can you still hear me, Declan?
Yeah, we can see you.
Yeah. So clearly the outlook for the global economy is extremely uncertain. The IMF published some very pessimistic, I suppose, forecasts in recent weeks, which constituted a far more pessimistic outlook than its previous prognosis. I think there's considerable uncertainty. I think the path of the virus is clearly going in very different directions in different countries, and this will be a critical factor. I think the outlook for the US and for the UK, which are, after the euro area, are the most important export markets for Ireland, are extremely uncertain. And really, I think the IMF estimated a decline in output of around 8 to 10% in each of those economies, which is very severe. The positive for the Irish economy is that our main exports tend to be acyclical. The last crisis showed this. IT services, chemicals and pharmaceuticals have not been much impacted this time or the last time by the weakness in global demand, and that is the one mitigating factor from us. And in fact, our decline in exports this year is, for that reason, less than for some other countries.
Okay, thank you. And Jens, do you want to add anything on the global outlook?
I think I can be very brief. I mean, Mark has answered it quite comprehensively. For Germany, it's clear we are a small open economy, and when the global economy turns down, then we will be hit hard. I think we have some reason to be cautiously optimistic when we look to China, because we see that economic activity recovers, and that German exports to China recover. But our most important trading partner is the United States, and there I think the risks of a second wave of infections and deeper downturn of the US economy are high. So for Germany, I would think the external side poses a significant downside risk to the baseline forecast. Sure.
Okay. Yeah, good. Another question for Jens. Jens, there's always in recent times two certainties in Germany. One is if they're involved in a penalty shootout, they'd win it. And secondly is that they usually run a balanced budget. So we are seeing, just with the big fiscal stimulus, that there really is a move away from a balanced budget. Do you see that as a change in long-term thinking, or is it really just a reaction this year?
I think it's not a basic change in long-term thinking. And people overlook that in the face of severe negative shocks, German economic policy has always turned expansionary. So after 2019, for example, the government also injected a massive fiscal stimulus. It does not seem to me that a majority of the German politicians or the general public would prefer to increase debt at a very high scale. We see with a massive fiscal stimulus that the debt ratio jumps from 60% this year to 70 last year to 75% this year. But if the economy recovers and a lot of these temporary measures are terminated, I think then the fiscal deficit and the debt ratio will recover too. I think what one sees is that if you have fiscal space and fiscal buffers, you are able to react, and when, if not now, it is time to use your fiscal space to help to mitigate the economy. All the more, a lot of the economic damage has come about by political decisions, the lockdown measures and the like. So I think there's certainly a higher obligation of the government to support the real economy and private households than in previous recessions. But I would not say it's a fundamental shift in thinking about fiscal policy.
Okay, yeah. And related, Mark, just in Ireland with the fiscal stimulus, do you think that we can sustain this without maybe an increase in taxation or maybe a return to some forms of austerity?
Yes, we do. We think the assessment is that the debt is sustainable. The figures under both the baseline, also under the severe scenarios. This reflects our forecast for a return to strong economic growth, coupled with a very supportive, favourable environment. In fact, the worst thing we could be doing now will be withdrawing fiscal stimulus. We think more will be required in the short term, at least. But it does leave us with a significantly higher debt, and in due course, when the recovery has strengthened, when we are back closer to potential, then we will undoubtedly need to reduce that debt. We cannot be looking to do that too early.
Yeah, no, that's very encouraging. Thanks, Mark. And then one final question. It wouldn't be an economics presentation in Ireland if there wasn't a question on property. What do we think this will do to property values, probably commercial and maybe residential also? Do you want to take that one, Mark?
Yeah, certainly. I would distinguish the two. I think in terms of residential, there will be two effects. There will be a negative demand effect, particularly in the short term. This is affecting employment and incomes and confidence. On the other hand, there will be a very significant negative supply effect, both because of lower output already seen, but also reduced capacity going forward because of physical distancing. So those two effects will offset each other in terms of prices, and we don't forecast property prices, but it's an uncertain environment. Commercial real estate is very interesting. It's very, like, on the one hand, in the short term, you may get, I suppose, you might get reduced demand. Even on the longer term, I think, as people work from home, people working from home environment, structural changes in terms of the environment. And of course, in Dublin, we have a large office sector, larger than most countries, with a lot of industries that are very suitable for working from home. So very interesting dynamics ahead there, I think.
Okay, yeah, thank you. Thank you. And just one final question, just we're tight on time. Just particularly with Brexit, do we see greater opportunities for greater trade ties between Ireland and Germany, where perhaps Germany or Ireland could take the place of the UK in terms of elements of the supply chain? Maybe that's a rhetorical question. Maybe that's a rhetorical question.
I don't know. I mean, what we observe with regard to Brexit is that a lot of it has been front-loaded. If I look at the relative importance of the UK as a German export partner, it has declined since 2015, 2016. I think so. A lot of these reshuffling of supply chains and exports has already taken place, and I'm sure that that Ireland has been able to take up an enormous part of what has been reshuffled away from the United Kingdom.
Yeah, for Ireland that has certainly happened, but we still have a food and agriculture sector that is extremely dependent on UK markets, and this is a sector, its future will depend on diversifying to other European, but also to non-European markets, and that will be so important for that sector.
Great. Yep. Good. Thanks a million, guys, and thanks everyone for the questions. There are still lots of questions coming through, so I think if you don't mind, we might even just forward some of those questions on to you, and maybe we could get some responses back to people. But that was hugely interesting, guys. Thanks a million. What I want to do is just for a couple of minutes, I just want to introduce Werner Schwanberg, who is a councillor and former president of the German-Irish Chamber. And Werner is currently chairperson of the German-Irish's European Financial Services Committee. So hi, Werner, how are you? Do you just want to say a couple of words and then to wrap up the session? I think, Helen, you need to switch the mic. I think, Werner, you'll have to use sign language. Not sure, maybe what I might do if Helen can't switch is maybe just on behalf of Werner, just you'll see a slide on your screens that we've recently formed the Financial Services Committee. Well, sorry, it's been there. I suppose we've recently publicized it more. So you can see, I think, from today that the German Chamber and Ralph and Helen have just access to really top quality speakers. The seminars are very high level. And you saw today, just I think that was an extremely valuable webinar. You'll also see some of the other sessions that are held held recently and some upcoming webinars, and that the Financial Services Committee is really there to help people. There's huge knowledge of businesses in Ireland and Germany, and also very well connected to politicians both in Ireland and Germany, and real thought leaders. So we're there to offer real help to anybody who is looking to transact financial services between Ireland and Germany. Werner, will we try once more? Can you come back in?
Thank you very much, Declan. And thank you for doing my job as well. So all that remains for me to do is, on behalf of the committee, thank today's speakers very sincerely, Ambassador Dike Potzel, Dr. Jens Ulbrich, Dr. Mark Cassidy, and certainly thank our wonderful moderator, Declan Bolger, and Irish Life for hosting this webinar. Thank you to Ralph and Helen, without whom nothing would have been possible today. And just to let you know, if you have any questions regarding membership in the committee or otherwise, please contact either Mark Coleman, the committee secretary, or myself through the email of the wonderful Helen. And finally, thank you all very much for attending. And I can only say all that remains is to say that stay in good health and good spirits, and I look forward to having you on one of our next webinars. Sorry. Goodbye.
Slán live.
Slán live.